Hey guys, welcome to Investify, where we help you grow your wealth through smart investments. Today, let's discuss a fascinating development in finance. Despite a challenging economic landscape, the stock market has experienced an unexpected surge, catching everyone's attention. Corporate earnings are dropping rapidly, making this rally a topic of interest and speculation for investors and analysts. In this episode, we'll uncover the reasons behind this phenomenon and explore its potential impact on your investment strategies. Staying informed is crucial, especially in uncertain times. Let's analyze the data, study the trends, and equip ourselves to navigate this dynamic financial landscape successfully. So let's dive in and make the most of these exciting times in the stock market. Corporations on the stock market are revealing their earnings result for the past 3 months. Despite what the headlines may suggest, it's crucial to be aware of a significant fact. Corporate earnings are actually declining, not increasing. While the media may portray earnings results as exceeding expectations and everything going great, this is far from accurate. The truth is that corporate earnings are now going down, not up. This situation has raised concerns among some analysts, who fear for a potential market correction or rug pull may be on the horizon. To better understand this, let's use an analogy. Imagine being a fan of the Chicago Bulls basketball team. In the past, they were a formidable force with Michael Jordan and Scottie Pippen, but currently they are not performing well. The expectations for the upcoming season have been dramatically lowered. If the media sets the bar extremely low, say at just 10 wins, and the Bulls manage to win 37 games, the headlines might proclaim that they exceeded expectations and are an amazing team worth investing in. However, in reality, the Bulls performed worse compared to the previous season when they won 40 games. The appearance of beating expectations is simply because the bar was set so low. Likewise, in the stock market, corporate profits have been declining year over year. In Q4 of 2022, earnings fell by 4.6%, and in Q1 of 2023, they dropped by 2%. The trend of declining earnings continues into Q2 of 2023. Being aware of these facts is essential to make informed decisions about your investments. While the media may present an optimistic picture, understanding the true state of corporate earnings will help you navigate the market wisely and protect your wealth. Stay informed and cautious during these uncertain times in the stock market. As the situation unfolds, it's concerning to note that earnings are currently down by 7%. However, the real cause for worry lies in analysts significantly lowering their expectations. It's crucial not to be misled by seemingly optimistic headlines. To navigate the intriguing stock market situation effectively, you have 3 options. Option 1. Stay informed and vigilant. Be aware of the misleading headlines and closely monitor developments to act swiftly when necessary. Armed with the truth, you can make better decisions and avoid potential financial turbulence. Option 2. Take a proactive approach. Fully understand that the situation is actually getting worse, despite the media's optimism. Being well-informed empowers you to make wise investment choices. Option 3. Adopt a buy-and-hold strategy. Don't get swayed by short-term fluctuations during Q2 earnings report. Focus on your long-term investment plan and ignore the earnings mania over the next 6 weeks. As companies report their Q2 2023 earnings for April, May, and June, around 10% of S&P 500 companies have already experienced a 7% decline in earnings. This marks the most substantial drop since Q2 of 2020 during the lockdowns. Moreover, there is a concerning trend of revenue growth being projected as flat, potentially turning negative for the first time since the lockdowns. This means that not only are profits falling, but sales may also suffer. The irony lies in the fact that despite the gloomy earnings outlook, about 80% of earnings results are beating expectations. This is a significant increase for the past 5 years average, where 77% of results beat expectations, and the 10-year average of 73%. This growing disparity between reality and the expectations set in headlines is concerning. Therefore, when you see headlines declaring that results beat expectations, it's essential to dig deeper and understand whether the companies actually made more or less money compared to the previous year. Reading the details behind the headlines is critical, as it can reveal the true financial health of a company. Remember, being informed and discerning in your investment decisions is crucial in these unpredictable times. By understanding the truth behind the headlines, you can safeguard and grow your investments wisely. Being aware and informed can help you navigate the complexities of the stock market and make sound investment decisions to protect and grow your wealth. Now let's take an even deeper dive into the captivating situation in the stock market. Despite corporations facing challenges and earning less money, an astonishing rally is taking place, leaving everyone wondering why. It seems the market is fueled by an overwhelming belief that the worst is behind us. According to prevailing expectations, the recession ended on June 30th, and from July 1st onwards, corporate profits are predicted to skyrocket. Looking at the consensus forecast for the S&P 500, quarter 2 of 2023 is considered the bottom. Yes, we've already passed the low point, and now quarter 3, July, August, and September, corporate profits are projected to reach near all-time record highs. The momentum continues into quarter 4 of this year, with expectations of hitting new heights. The icing on the cake? Brace yourselves for 2024. It's predicted to be an economic boom like never seen before. What's driving this incredible optimism? The answer lies in the unstoppable AI revolution. The market believes that the widespread adoption of artificial intelligence will result in monumental economic activity and boost productivity. This, in turn, is expected to propel corporate profits to unprecedented levels starting July 1st of 2023 and well into 2024 and 2025. But let's be cautious and discerning here. While AI indeed holds immense potential for specific companies in certain industries, there are differing opinions on its immediate and widespread impact on the entire S&P 500. Some experts feel it's a bit early to expect a miraculous and uniform boost in profits across the board. Looking ahead, it's crucial to acknowledge that economic challenges may not be entirely behind us. From a broader perspective, there's a possibility that the worst might still be ahead, given the downward trend in both GDP and corporate profits over the past 3 quarters. This trend implies the likelihood of encountering further obstacles in the future. In navigating this uncertain landscape, prioritize staying well-informed. Knowledge is the best asset in these times of volatility. Understanding market dynamics and being prepared for potential shifts are essential elements in making prudent investment decisions. To make informed choices, conduct due diligence by thoroughly analyzing economic data and corporate earnings reports. These valuable insights can guide us through the unpredictable nature of the market and help us make well-grounded decisions. Remember, markets can behave irrationally for extended periods, so it's vital to remain financially prepared. Stay informed, stay vigilant, and equip yourself with knowledge to navigate the financial landscape successfully and seize opportunities along the way. That's it for today. Thank you for watching. Don't forget to like this video, subscribe to our channel, or ring that notification bell for more updates here on Investify.